Hey guys, so in this video today, we're going to be talking about how does Chubb Life Insurance income protection product works. For you as a consumer, a bit of an insight. Remember that it is not an advice, so do not take this as any kind of advice. Although I am a financial advisor who work in insurance, basically working for life cover, disability, income protection, health cover. So all of that is my expertise area. However, every individual has got certain circumstances which are specific to them, individual to them, and that is why this is not a specific advice. This is just an insight into what income protection is and what does Chubb has to offer. I'll be covering different providers in different videos in coming days. So today I'm just covering what Chubb, which is one of the top insurers in the country here in New Zealand, what does that have to do with income protection? Okay, so we'll take some simple numbers to have a play around with, so that you guys understand how does Chubb income protection works. Just give me a moment. So let's say let's understand the risk. Why do people need income protection, or why do they look into having income protection? As the name suggests, income protection, what risk are we covering, is what you as a consumer needs to start thinking about. As anyone who's earning income, what is your biggest asset? Your biggest asset would be your ability to earn income. And if you were to think about scenarios where you were not able to earn your income, what impact financially that would have on your family in terms of paying the bills, paying the mortgage, daily expenses, and all of that stuff. So this product called income protection is covering the risk of losing your income, basically. So in simple words, if you have this income protection cover, that will help you protect any eventualities which stop you from working and ability to earn your income. So for example, if you were to get ill or sick or get injured and you're not able to work, okay, that is where this product called income protection, I use it IP, income protection, will come handy. Now, a lot of people do think of income protection as redundancy cover as well, which is not correct. Redundancy cover is a separate product, which I'm not going to talk about in this video, so that you don't get confused. But we're going to just focus on income protection. For this sake of this video, just understand that income protection is not redundancy cover. Okay. Now, coming to what income protection is and what it does. So it is to cover the risk of your loss of income because of illness or injury. That is the prime purpose, the prime sole reason for having this income protection in place. So if you are an employed person on PAY earning an income and you get sick or you get injured and you cannot, let's say, work for example, 3 months, 2 months, 6 months, 1 year, or for the rest of your life, if you have got income protection cover, depending upon what type, it can help you cover some of that cost or some of that lost income that you were earning when you were able to do work. Okay, so that is what income protection is. Now we're going to discuss specifically about what Chubb has to offer and what is out there in the market with Chubb Life in New Zealand right now. So what Chubb has got, they've divided this income protection into 4 different types of product, and it really depends, and that's why it's very important for you to really have a good advisor with your side, so that you can understand what fits your circumstances. For example, a person who's got a self-employed business, he's a shareholder, contractor, their situation will be completely different when it comes to their income, because their income is fluctuating. It could be seasonal income, it could be yearly changes, it could be something else. Depending upon the nature of the business that they run, their income might fluctuate. Whereas a salaried person, an employee, or a CEO, or a shareholder of a company who's just withdrawing salary from them, that scenario is totally different, because their income is more or less stable or in a steady growth phase year after year. Okay, so it's very important that you understand your situation with an advisor, and then they will recommend you. So let's understand the first one. Number one product, it's called agreed value. Now, for the ease of understanding, what we'll do is we will take an example of a salaried person for this particular product. Let's say a salaried person is earning $100,000 a year per annum, and they've got this product called agreed value with Chubb Life. What this is meaning is they can get their income covered maximum up to 62.5% if they go for agreed value. So that's the highest amount of income protection that they can have with Chubb, which is 62.5%, which is $62,500 per year. You can divide that by 12, and that will be their monthly sum assured. Okay, so 62,500 divided by 12 will be their monthly sum insured, which means if that person gets injured or gets sick and cannot work after the waiting period, which I'll talk about shortly, Chubb will start paying them 62,500 divided by 12, whatever that number is, every month into their bank account. Okay, but that's the highest amount of cover that they can have under this agreed value policy. Okay, now here's important thing to understand: these two conditions, illness and injury, and how they both can play out in where we are in New Zealand, and what other kind of support that we get or you get as a somebody who's looking to buy insurance. It's important that you understand what other options are there out there. So number one, you all must have heard about ACC. Now, if it is an injury and it has been recognized by ACC that yes, it is an injury and you qualify for that, they will pay you up to 80% of your income. Okay, I'm not saying they will always, but like I said, they will assess, and if the claim is approved by ACC, you can get up to 80%. Sometimes it could be less, sometimes it could be 30%, 40%. It is totally depending on ACC and what their criteria are for the claim for the injury. Okay, so it's not guaranteed, but this is the maximum that you might be able to get from ACC, 80%. Now, let's go back to our previous example, which means if you are insured privately with Chubb for $62,500, you get an accident, you break a leg, badly injured, you cannot work for 6 months. ACC covers you for 80% of your income, which means ACC is paying you 80,000 of your salary divided by 12 per month. You're getting this from ACC. Would you get anything from Chubb? No. So in this case, you will not receive any money from Chubb if ACC is paying you 80%. Okay. If ACC was paying you, for example, let's say only 40% of your 100,000, it means 40,000 divided by 12, whatever that amount is, you will still be able to get 22.5%, which is left over from Chubb. Okay, I hope that makes it clear. Now, ACC is just one part of what you might be able to earn. On top of that, if you're earning any other income at that time when you're injured, let's say in the same example, I break my leg, I cannot work, ACC is paying me 40%, but I pick up a part-time job, admin work, which I can just sit at home and do from computer, and I get paid for whatever, 5, 10, 15 hours a week. I earn another $500 a week, for example, which comes out to roughly about $2,000 a month. That will also be deducted from my private insurance from Chubb. Okay, so the whole idea that you need to understand with agreed value is, if you agreed a value of 62.5% or any amount with the private insurance company Chubb, they will pay you that amount, but they will deduct any other earnings that you are earning or getting from ACC, any other job that you might be doing at that time, or any other maybe work and income support that you're getting for that specific injury related thing. So those things will be deducted from the agreed value amount. So I hope this makes it clear that when you look at just agreed value, it doesn't mean that you will get the same exact amount which is on your policy document in your bank. It depends at the time of claim what are these other scenarios taking place. Okay. Now, second thing I'm going to cover in this one is indemnity cover. Okay. So that's the second type of cover that Chubb offers. Indemnity cover means you can get cover up to, let me just write here. So I hope you can see the board. So you can get cover up to 75% if you take the indemnity policy. Okay, so 75% versus 62.5% is the difference mainly. Indemnity. So let's have a look at this one. So you got maximum coverage of up to 75% of income. So that is the first big key difference. The amount of coverage you're getting here, 62.5%. Over here, you're getting 75% of your annual income. Now, however, at the time of claim, what will happen is the insurer, Chubb, will look at your income at that time. And if your income has dropped, for example, then you will get 75% of that income. All right. So let's take a hypothetical scenario here. Because if you're a PAY, which is an employee, the chances of dropping in income are quite low, but they can happen. So for that ease of example, we're going to take a contractor or a self-employed person, or he's a tradesperson, and let's say they insured themselves for $75,000 with an income of $100,000 at the time of taking the policy. They take the indemnity cover with Chubb. They're insured for $7,500 per month, but at the time of claim, what's happened is this person, after let's say 3, 4, 5 years, at that time he didn't realize that his business will struggle, and his business income's gone down. He's shown less income to save his taxes for whatever reason. What Chubb will say, they will ask for proof of income at that time. Now, proof of income could be your financials for the 12 months before the injury has happened or the illness has happened. Or actually, the good thing that Chubb does is they give you last 3 years of best income. You can take that. So if your income over the last 3 years has fluctuated, you can pick the highest amount of income that you've shown IRD and provide that to Chubb, and they will take that. Let's say, for example, the best income year for that person was, let's say, $70,000, which means they will be able to claim 75% of 70,000 divided by 12 per month is what Chubb will pay them every month. Okay. Now again, if they're getting anything from ACC or any work and income or any other part-time job at that time, that will be deducted from this indemnity because that's part of their income. So if they are showing that as their income, that is going to be deducted from that. Okay. So that's agreed value, that's indemnity product. Now Chubb has also got 2 more products which are really kind of different, but to some extent similar to these 2, but they really can be helpful if you are a tradesperson or if you're somebody whose income does fluctuate. So let's understand those 2 products here. I'm just going to turn this one around so that you can see the whiteboard here. Okay. So what those 2 products are. is called, the first one is called loss of earnings, LOE, and the second one is called loss of earnings plus, or loss of earning extra. Sorry, loss of earning extra. Okay, so LOE and LOE extra. What these two are, as the name suggests, loss of earnings. Okay, so you're assuring yourself for the risk of the lost income. So let's go back to the second example of the trading, where the person was earning 75,000 at the time of buying the cover. If they have got loss of earning cover here, and their income has dropped down to $70,000, for example, at the time of claim, what the insurance company will see is how much income have they lost because of that injury or illness. Let's say, for example, after the disability or the injury or sickness, that person is only able to earn $10,000 now, hypothetically. $10,000 only for the whole year, which means their loss of earnings has been 70,000 minus 10,000, which is $60,000. So they've lost in earnings of $60,000 per year. They were insured for $70,000 at the beginning. They've lost $60,000 of their income, which means Chubb will pay 75% of the loss of earnings to them, which means 75% of $60,000 divided by 12. That is the monthly payment that Chubb will pay. Now, that will that will be calculated in case if it is an injury and they are getting anything from ACC, then that income will be calculated as part of income, which means their lost income, let's say for example, ACC pays them another $10,000 per annum. That means their total income after the injury and disability becomes $20,000 per annum. That means their lost income is $50,000 per annum, which means Chubb will pay them $50,000 divided by 12 every month in their account. Cool. Now coming to loss of earning extra. Now, loss of earning extra is probably the best possible option in terms of tradespeople, self-employed, income fluctuating. However, do not take this as personal advice. There is a lot more other factors that we need to consider in that. However, loss of earning extra, let's say the person was assured for $70,000. At the time of taking the insurance, they injured themselves, they cannot work, their income has dropped down to $10,000. Their total loss of earnings have been, because ACC is paying them, let's say $10,000, their lost income is totally again $50,000. Now, this one, they are in a better position compared to this one, loss of earnings. Why? So with this one, they will get paid the greater of the two figures. Greater of which two figures? Loss of earning extra works on this calculation. They will get greater of either their total lost income, 75% of that, so 50,000 into 75% of this, or whatever was their sum insured, which means $70,000 into 75%. Whichever one was their higher amount, they get paid that. Okay, so that's how basically this thing works. Now, there's a lot of information that I've just given you here. So it's important that you really understand what you are getting and how it works at the time of claim. Does it apply to your situation? Does it apply to your circumstances, your financials? There's a lot of things that you should think through at the time of claim, which could be something like, okay, if you're husband and wife, what would happen if you cannot work because of an injury or illness? Would your wife be able to take some time off work as well to look after you? Would she need to? Would your kids be able to manage the drop offs and the pickups, or do you need to add that cost of daycares, etc.? Does the cost goes up? Would there be any expenses that might increase, or would there be any expenses that might reduce when you are not able to work? So these things are really important to discuss with your financial advisor, with your insurance advisor when you purchase insurance. So the only thing that I would advise or suggest is, do not just buy on cheap price. Especially these days, it's very common. People go online, they just look at the broad headline of the cover, and they don't go into the details of it, and they have no idea how the cover will work out at the time of claim, at which point of time they often can get disappointed because the claim is not declined because it wasn't there in the policy, because they didn't understand the cover and they didn't think through what possible scenarios can happen at the time of claim. And that is why it's really, really, really important that you really understand and take some advice. And to be honest, most insurance advisors, they're not charging you anything. So just do your research. Call, pick up the phone, text, leave a comment here. I'll be happy to absolutely help you out with any question that you might have without any obligations. You can call me direct. My number is 0212793040. That's 0212793040. My name is Nitesh, and I work for Advice for Life. You're based in Auckland and Albany. So give me a shout out.